the recording. Yeah, so some people were saying in the group that they couldn't attend, so they could probably access the recording. I was a bit surprised when I first shared I was a bit hesitant, to be honest, to initially share my idea of creating that WhatsApp group with financial freedom in mind, because I thought I might be the only person thinking about this. And then a lot of people kind of came forward, so I was a bit surprised and pleasantly surprised. And then, as many of you know, the WhatsApp group limit hit quite quickly, which is why we then moved on to the Telegram group as well. There are a few new members in the Telegram group who weren't in the WhatsApp group because of the numbers limitations as well. And we have the separate service, the GrowWealth service, which just a few members are there. So yeah, it grew because of the strength of the group itself, rather than an individual person.
Yeah, no, I think that it's a wake-up call, actually, especially for, I don't know about the others, but especially I've spoken to a few doctors within the hospital. And whilst I guess, especially in our profession, that we get so ingrained into learning the tricks of medicine, surgery, being very good technically and being a fantastic specialist in whichever way, whichever specialist you are, you kind of lose track of what is actually happening in the rest of the world. So in other words, you create a world of your own, you live in that world, you live in that bubble. And then when something like this happens, you just realized that there's more to this world than this bubble. Indeed. At least this is what I've realized.
Yeah, that's very true. That's very true. And you're totally right. I certainly felt that because my friends group are all kind of doctors. And I kind of, when I go to other groups socially, where there is more non-doctor groups, I really struggle to strike a conversation.
Yes, same here. I think when the children actually, when there are compulsory, before the COVID happened, when you had to actually go to these parent-teacher meetings and parent hangouts, you are the only one with a drink in your hand, and you desperately try and find out another doctor in that group and say, "Oh, you are a GP. Oh, yes, oh, I'm a gastroenterologist. Thank goodness for that." So I think because of our own professional responsibilities, training requirements, moving countries, etc., we are just. I think this is a self-imposed survival tactic that people actually use, but over years it just adds up. This is what I felt.
Yeah.
I don't know what the others' experiences are the same.
I guess so. Over the years, I grew to believe that I'm not the only one feeling the way that I feel. Having seen so many situations where others have also come forward in the same with the same view. Because there are a few of us who are relatively new to the group and also to the other things that's been going on, and I was also a bit scared of not knowing what to talk in this session, so I created a couple of slides just as a prompt. Maybe I'll go through that for the first 5 minutes, and then we can have a kind of informal catch up, if that's all right.
Yeah, absolutely.
Gives some time, I guess, for others to also think about how to best use our time, I guess. Except Vanita, who may have to go and make some dinner.
Yeah, I have to start. I'm not even prepared anything. No, maybe in middle I'll go. Otherwise, I'll have to ask my husband to help a little bit.
Well, I'm giving you an opportunity there. All right, so it's just a brief slide. And we might be talking about what we do in the Telegram group and what we do in the GrowWealth page. Or I also had some thoughts of maybe looking at stock market charts, overall, the overall index. So I just want to kind of put this forward that we are sharing experiences, it's learning purposes, not an advice not a personal financial advice or advice to buy or sell and things like that. Anything that you hear, take it in the context and do your own kind of research as well, because you alone would know your personal situation, financial situation. So use this for information. So some of you know me personally, many may not. So I'm a psychiatrist in UK, been here for 15, 16 years now, but interested in stock market for about 13 plus 14 years now. Initially India, then UK, now US stocks. And I'm interested in teaching. I do that in my work in psychiatry, and I've always done some teaching in whatever I was doing. And then when I saw more people are interested in this in similar situation, like medics and healthcare professionals, so I thought, let me do that. That's how the WhatsApp group came up, and then now Telegram group, then subsequently the GrowWealth page for selected people who are more keen to learn a little bit more and more direct discussion and on stocks and things like that. So all of you, I guess, are from here. We start around, I can't remember the exact start date. It's probably beginning of November or maybe end of October, I think. But it soon hit 257 max limit. And then we moved on to the Telegram group. Currently, we have 268. There might have been more, it could have been more, but due to some members' request, I'm limiting to just the Indian doctors at this point, Indian doctors and healthcare professionals at this point. Hence, it's at that level. Let's see how this goes before we expand any further. And the discussion has been really kind of wide-ranging, isn't it? Covers everything: stocks, real estate, cryptocurrencies, EIS investment, which brokerage services, tax-efficient accounts, all sorts of things, international investing, passive funds, ETF, investment trust, and all sorts of things. So yeah, thank you for contributing to all of this kind of really encouraging, vibrant comments. And I think, as I mentioned earlier, it's growing from strength to strength, and the strength lies in the numbers as we have, and all of you are chipping in and sharing your thoughts and learning, and also asking some questions, which kind of helps others learning as well. I thought it's rather than just doing a lame presentation, I'll put some useful information, those who are interested in reading a bit more. So these are real great classical books. If you're interested in stock market investing and trading, these are some of the must-haves, must-read books. I can't choose one particular one because all of them are good. So you can make a note of it. And of course, this is recorded, so you will have it in the recording as well. A little bit about the GrowWealth service that I have separately. And we cover quite a lot of a big range of topics. It's kind of freemium type service. The majority of the posts are free. Anyone can read. It's an informal page setup. I didn't want to create a very formal looking serious subscription services because that was never the intention. There is a membership, there is some subscription to cover the cost and to help some more keen driven people with selected kind of stocks focused, long-term investing and trading focused discussion. But many articles are free as well. And if people feel useful, the articles, then they can contribute by buying me a coffee, hence the name, a small amount of kind of contribution for the page. So that's how it's going on. The plan, I got a few other plans, again, depending on time, but some of them will be introduced later this month in terms of changes to how I kind of share the watch list. And I'll be sharing my universal watch list. So everything that I'm watching will be there. So it'll be a lot of names, but I guess it covers, it gives the members a lot of understanding of what I'm looking at and why some week I'm trading some and the other weeks I'm trading a different stock. So that'll be one. And then periodically I also share specific stock ideas that I myself are interested in investing for long term. I'm not a expert in any means, but in stock market, there are stalwarts in the stock market. But the method I've learned and tried and tested and adapted is certainly working for me over the years. And what I'm trying to do with GrowWealth is kind of simplifying it and sharing with others. I'm investing and I also trade shorter term as well. Investing is my bigger portfolio. Trading is my smaller portfolio. So I do know that long-term wealth creation comes from investing. So I have various sources. Many of them are subscribed sources for me. I get information from there. Instead of you subscribing all of those services, I collect some of those useful information and share with the group here, with my members in GrowWealth. So I'm putting a draft for one of the long-term investment stock for this month. Both the groups, the GrowWealth and the Telegram group, are pretty much aimed at this one goal, which is to expand our comfort zone when it comes to financial wealth, financial health, and financial freedom. And doctors, although we deal with quite a lot of risk from life and death point of view, when it comes to finances, I think we are not that much knowledgeable in managing the risk or taking risk, which is what I figured from speaking to many of my colleagues and in the group as well. So our financial comfort zone has been very small. And my kind of hope and aim through this kind of groups is to try and educate, share, involve everyone in a free discussion, non-judgmental, non-critical kind of environment to impart knowledge and also encourage you to kind of experience some of the safer way of the investing, thereby expanding your comfort zone. It doesn't mean that this picture is slightly bit confusing. So it says comfort zone with the smaller circle. But the aim is when you expand that comfort zone till the growth zone, all of that becomes your comfort zone. So it's not about going out of your comfort zone. It's about expanding your comfort zone by acquiring new skills and dealing with any challenges that comes from it, again, by learning new skills. And so that you go into the growth zone where you live your dream of hopefully early retirement or safer retirement financially for future generations as well, able to set and achieve that financial goal. So that's one of the aim. Just a little bit of unashamed advert here a little bit for GrowWealth watchlist, up to date as of Friday. So overall, it has, as a group, it has outperformed the S&P 500 recently due to the rotation. There's a bit of underperformance from the watchlist compared with the S&P 500, but as a group, it's outperformed. Again, this is just 2.5 months, 2 months plus performance, which isn't something to be tooting about, but it's the kind of a sample of how it has been doing so far. So that is the slides that I had. And let's come out of this slide share. Give me 1 second. Oh yeah, there it is. So just a few slides to give you an overview. If people are interested at some point today, we can look at some of the overall market index charts to share my thoughts on that. And if you had any questions or comments separately outside of that, we can maybe talk about it now. I'll be guided by you guys. Can you all hear me?
Yes, Vinod, we can hear you.
It was very quiet, so I thought I either bored you or my connection had dropped.
No, we can hear you. Can you hear me?
I can hear you, Raman. Yeah, thank you.
Yeah, great. Yeah.
Thanks. Was that helpful? And I'll post the book recommendations later as well, which is good.
Thank you.
Thanks, Vinod. That was really helpful.
Thanks. Either verbally or through the chat, if you can maybe say whether you're how active you are into the stock investing, what approaches you are taking, whether you have an account or not. I know there's a wide range of experience in the group here.
So I'll go first then, since there are no takers. So I guess I kind of knew something was out there earlier this year, so in earlier 2020. And just on some recommendation of a few colleagues, opened up a HL account.
Mhm.
And you really didn't know what's the difference between a stocks and shares ISA or a SIP. Absolutely zero knowledge. Because I think the first, I can say the first 21 years of your life after coming out of a medical school is just spent on acquiring your professional knowledge. And then now that, I would say, as you suggested, now that you're in a comfort zone, all established, consultant for a few years, and you start looking at things and say, where are we heading towards? And then you start to realize that there are opportunities out there. There is an account, HL, and there are other people. But I guess there is no single point source of information that actually easily dissects. Either there are vested interests of people trying to sell stuff in terms of different platforms trying to sell different platforms for that matter, like money saving experts would actually try to sell you X, Y, or Z platform versus others. So there's no way to actually, there's no easy way to basically select impartially or by an informed decision as to this is the platform that you want to choose, these are the stocks and shares. But I think if that can be, so the biggest learning that I've actually had is the same, that, once you achieve what you do, in the field of medicine, but you can't ignore it, the other aspects of it, which, yes, I have. But so that was early 2020. And then financial freedom happened. So I just put in a few stocks, randomly picked up some funds, and no knowledge what a index fund is, or what a passive fund is, or an active fund is. Either you're too busy with your job, or when you come back, you're too busy with your kids. And in the spare half an hour to an hour that you actually get, you just want to get the information then, and then try and actually wrap up the day, and then prepare for the next day. I guess that's how it goes. And then when you actually started to go through all these funds and all the discussions and things, it provides a seed on which you can actually build up your information, and that actually then grows. And this is, I guess, what knowledge I had last year is and versus this year, it's phenomenal. Not that I've actually taken any different approach, but it's just the knowledge itself. It gives you some confidence when you look at the charts, when you look at the funds, when you read about the funds, when you look at the key information documents.
Yeah,
it makes sense, and it's not Latin anymore. So
no, that's great. It's the first, people say the first impression is the best impression, or you don't get the second chance for the first impression. So investing in stock market requires that good first step. There are some in our group, including myself, who did not have that good first experience with stock investing. But those who started in 2020, except in some rare circumstances, would have had the good first experience, because 2020 has been a complete flabbergasting outlier year. Almost everyone who invested would have made money because of what happened, because of the governmental kind of injection of the money and all the kind of quantitative easing and all sorts of things. And the stock market has done really well. The exceptions I mentioned is the UK stocks. So many of the UK stocks, which are not that growth oriented, it's mostly kind of cyclical and oil companies and those major kind of blue chip companies. They didn't do as much as many of the other US companies, emerging markets like India and others have done. So in majority of the cases, people have done really well, having started in 2020. So it may have given people a good first step, but that also concerns me a little bit, because the earlier on quote unquote kind of stumble or the failure that people experience in stock investing gives them the right learning. If somebody had beginner's luck or early on success, unless they continue the learning experience, they have the risk of kind of becoming a bit more complacent and thinking stocks only go up. There are hashtags. You may have heard people talking about stonks, referring to, that's a short form of saying stocks only go up. So stonks mean, colloquially, it means stocks only go up, because that's what it's done since the coronavirus crash. So there's a group of people who just started investing just after coronavirus crash, who had seen the returns exponentially grow and quite easily without much of personal individualized learning. So that is a little bit of a worry for me, that people might fall into that trap, because it's going to correct at some point, and people need to know what to do, how to respond to that, and not assume that it will always go up and hold on to losing stocks and miss out on the profits that they had. So some of my recent comments in our group about partial profits, manage your stop loss, know what's your trade plans, is all driven by that kind of apprehension, so to speak. So that's quite important to be mindful of. So you're doing it in the right way. You're learning it as well as investing it, and have a plan why you are there. Know your purpose, so to speak. Like I mentioned in the slides, I have an investment account and I have a trading account, and them two are completely different approach. Anyway, so I know the purpose of the investment account and I approach it differently. I know the purpose of the trading account, I approach it differently. So as long as you have a clear idea of, okay, why did I start this brokerage account? Why did I invest in that particular fund or that particular stock? And that clarity is important. And once you know that, then that's fine, because you would then know, or should know, what happens, what you do about it when it goes 20% up, or when it comes down 15% or 10%, because you would have a plan in advance. If not, use our group and learn further and create your own plan. No one else can give you a plan, because it won't be your plan. It will be their plans. You need to have your own plan. So that's something I want to kind of share. And you might notice many of my recent message and more messages to come will also be kind of drumming that message across, because stock market is a little bit heated. It's a bit frothy, and clearly the last week and a bit of growth stock movement suggests that there is a bit of rotation happening. People are warming to the idea of a lot of millions of people being vaccinated. They're banking on the hope that the economy will reopen. So those stay-at-home technology stocks that has done really well in 2020 and beginning of 2021 is kind of lagging a little bit, and that money is being moved to economy opening kind of recovery stocks at the moment. So it's quite important. So that may lead to, if you're investing in, say, one of the excellent stocks that did very well last year, now it might pull back in that rotation. So that's something to be mindful of. There are a couple of questions on the chat section about IPO in UK and US stocks and how do you apply. For US stocks, you can't apply before IPO. I don't think you can unless you have access to that kind of investment banking kind of accounts. So most we can't do that. Pre-IPO, we can't do that. UK, I think you can apply pre-IPO for the IPO price if your brokerages allow that. I have an account with Interactive Investor. I always had it with Interactive Investor from the very beginning, and through them, some of the companies where they go on IPO, they link up with the brokerages accounts to have access to those retail traders as well. So Royal Mail, when they came public, Interactive Investor had allowed access for the retail investors to invest through them. So I applied. I said how much money I want to invest in that particular IPO. And when these shares were allocated based on how much was assigned, then I got a little bit of share when it came public. I don't know whether other people have other experience of doing that. So I've done that through the brokerages. When that so it depends on which brokerages the companies go with as well. I haven't tried looking at individual company websites. Sometimes they may do that as well. So if you know a particular company is coming public, you may want to go to their website, company website, and look at investor relationship tab or the page to see if you can gather more information on that. So going with bigger brokerages has that advantage. But nowadays, most execution-only brokerage, like Free Trade or Trading 212, bring on those IPO stocks to their list of tradable stocks quite quickly as well, unlike before. The trading account I have is with Interactive Brokers. They're one of the world famous ones because I trade primarily in US stocks, and that's one of the good ones. And they have the IPO stocks available on day one of trading, coming public. So that's one way of accessing. But to get an IPO price, you need to have applied and you need to have been assigned the stock before it comes public. For US stocks, I don't think you can do that. For UK, as I mentioned, if your brokerage is support, then you can do that. In fact, it was the Facebook IPO in 2012 that interested me in opening up the Interactive Investor account. Until then, I was kind of trading and investing in Indian stocks before then. So it was the hype about the Facebook IPO that got me into the US stock market. But funnily enough, I never invested in Facebook after opening the account until a few months ago, actually. So I missed about 10 times the growth, but it's still a growth company, I think. So I hope it gave you some answer. There was another question about dividend investment, long-term. I'm not for trading, I'm for investing stocks. How do you advise in the account setup to get dividends? So I think the question is from Geetanath. So,
hi, Vinod. Yeah.
Yeah.
Just to avoid unnecessary transaction fees. So how do you do that?
Again, it comes down to your purpose, Geet. So if your purpose was dividend reinvestment for long term, we have a couple of real experienced people in our group who do that. And I used to do that. I had a part of my portfolio in dividend investment. I now totally moved on to the growth stock investing. So the approach towards dividend investment, I would say, is longer term. One of the main reasons to go with a dividend paying company is to accumulate the dividends over a period of time. So it becomes, it gives you much more cumulative growth, compound growth over a period of time. So you would want to be reinvesting that dividend. Sorry, Vinay, is that something you wanted to share? Okay. or maybe people can raise their hand and then I'll call out if they wanted to add a point. So say if you found a really good company that pays you healthy dividend and you want to keep it for many years, maybe many decades, then you would want those dividends to be buying more shares whenever they pay you the dividend. Does that make sense? So that's like free shares for you. They're paying dividends, but then the brokerage firm will automatically buy you those shares based on how much dividend you get.
So will there be any difference in the price of the share when you get it as a dividend or when you buy on your own?
So if you initiate a buy order, then you pay the whole trade fee commission. For Interactive Investor, it is about $7.99 or something. For HL, it's about $11.25.
11, yeah.
Yeah, $11.25, $11.50. So because it's a new order from you, you have to pay that fee. But if it is dividend reinvestment, Interactive Investor charge you £1 because it's automatic. And HL may also have, I don't have HL account, so I can't say specifically for HL, but I'm guessing they will also have something low or no dividend, no fee for that at all. So you don't want to check. So if you're in it for longer, you want to grow that and have a compounding return, it's best to then initiate that automatic dividend reinvestment. It's called DRIP, dividend reinvestment plan or something like that.
Okay, thank you.
So that's the best way to do that. For some people, let's say if you have a very planned approach to your portfolio, each stock shouldn't go beyond this much percentage of my portfolio and things like that. And after that stock hit that level of percentage of your portfolio, you don't want to have one big position in your portfolio. So in that situation, sometimes what people do is they stop that dividend reinvestment, accumulate that dividends paid, and then use that money to invest on something else. So you're not putting in extra money. You kind of pause that dividend reinvestment and then use kind of siphon it out to something else that you want to invest. So that's another strategy as well.
And another question is, someone mentioned about discounted shares. So how do you buy those discounted shares? So in our financial freedom platform, somebody mentioned about Brexit discounted shares only for a limited period. What is it? Because I couldn't see anywhere like that.
It's the figure of speech. So because of Brexit, and also because of the recent coronavirus and things like that, the UK shares are trading at a discount compared to some of their counterparts internationally, or compared to their long-term average. So it's not like we can access a share at a discount to what the market value is, but the shares are trading now at a particular level below where they have traded on an average in their history because of some recent economic and geopolitical situation. But it's not going to be there forever. Brexit has happened, so it's not an uncertainty anymore. It will come back to some normality once people figured out the normal life. It becomes a new normal. Then the stocks then recovers, doesn't it, when that happens? So that's how I understood it when it was mentioned in our group as discounted shares. Because of that
50% discounted. So I was not sure. When I looked at the price, it doesn't reflect that way.
So you get what it trades at the current market. But compared to the historical average, or compared to the value of the company, it is considered to be trading at a lower level. Because of the Brexit, not many people are very optimistic about UK companies, for instance. But with time, with further trade established with other countries, UK might kind of establish that confidence in investors, and the stock price might recover. Then you may not have that kind of discount. So that's what I think that's what they were referring to. Arvind, you have your hand up.
Thanks for that. You see, if we say that the market is actually going to correct and you are invested in funds, What's the approach that now with, I gather that trading in stocks is easier. Well, not easier, but it's, you have a strategy for that. What's the strategy for funds?
Okay, the strategy for fund would be something similar to the dividend investment, because the reason to go for the fund is to have it a little bit less active or passive. And that's the reason to go with the dividend investment as well. So you would want to be, your plans should be long-term. I know some people kind of, if they have the right approach and knowledge, they chip in and out of the funds as well. I wouldn't necessarily do that. Because say, for instance, again, it depends on what fund you're invested in. Growth stocks the individual growth stocks I invest in is primarily in NASDAQ index, and also many of the growth stocks are in S&P 500 index as well, right? But if the fund that you're invested in has a diversified approach, so let's stick with just US for argument purposes, right? So they may have invested in quite a lot of other funds that are listed in Dow Jones Industrial Average funds as well. And last week, I think Dow Jones performed better than NASDAQ, right? So you may want to come out of the index fund completely, because some of the index would be doing really well. Some of the stocks would be, if there is a rotation, for instance, if the money is coming out of the growth stocks and going into kind of recovery play, that index will go up, for instance. So, and that's when it becomes a very tricky game, when to come out, when to go out of it. If you have purely invested in NASDAQ tracking fund, index tracker fund based on NASDAQ, then you can look at the NASDAQ chart, and similar to how you would analyze individual company's stock based on the chart, you can do something similar with that index as well, if you know which index that they're following, and you can have the technical analysis for it. But if you have that knowledge of, this is my personal view, if you have that knowledge of how to analyze this chart in order to get in and out of an index fund, I would recommend go for the stocks, individual stocks, because if you know that much knowledge, choosing the right company stocks and investing in it appropriately gives you much better return. And people sometimes think about kind of individual stocks mean you have to have a very concentrated portfolio, and that increases the risk. I do know quite a lot of full-time traders who do that, full-time investors who do that, have just 10 stocks or 15 stocks, and they do that very efficiently, but they do that full-time, right? You just saw the slide in the earlier presentation from the watch list that I shared with our group, GrowWealth. So we had 130 different selections in the last 2.5 months, right? Nifty 50 in India have 50 stocks, right? Dow Jones have 30 stocks. S&P 500 has, funnily enough, 505 stocks. NASDAQ has 100 stocks. And the watch list had 130 stocks, and it returned 20.5% compared to 4.2% in S&P 500. So having many number of stocks doesn't necessarily mean reduced return. You actually diversify it in that way, but depending on selecting the good companies, you actually do well over a period of time. So if you're going purely with index passive funds, index funds and things like that, be in it for long term. If there is a seismic shift or change, the floor is breaking down under your feet, like coronavirus crash, then yeah, you can get out of it and then get back in. The problem with that is it's easy to get out and difficult to know when to get back in. Those who have done that at the beginning of coronavirus crash, they were happy for 3 weeks, because say, for instance, they got the top correct and got out of the market on February 22nd or whenever that is. It might make sense if I share this slide with you. The chart with you. Can you see the charts?
Yes.
So let me go to. So this is the S&P 500. Okay.
Mhm.
So right here. So let's say they looked at this, or maybe the day after it gapped down below 50 EMA. So they looked at how much it went down, and let's say people got out of here, right? And this is what many of the big money managers, hedge funds, banks did in US, right there. They got out of it there. Because they got so much invested, they can only do it over a period of time. They can't sell everything together. So you can see the volume has increased. That is because big money were selling, money managers, hedge funds were selling every day. That's why it kind of plummeted 35% in less than 30 days. But once you got out of all of your position, and when it is at the yearly low, or it's actually the lowest in 4 years. So the coronavirus crash bottom is the lowest in 4 years. And all you read on the newspaper or on TV is thousands of people being diagnosed with coronavirus, hundreds and thousands of people dying every day, right? And how the market has kind of completely plummeted. When it did this next few days, right? Do you think you would have the confidence to get back in with that headline? You wouldn't, right? Am I making sense?
Yeah.
Because you would feel, and even I've been following the market quite every day, as you know. So even until here, where it went all the way to the all-time high again, and when it did a little bit of pullback in September, October period, people were expecting that it to completely come back and retest this bottom here again. Because historically, whenever the market corrects, there has been retest of that particular low. So the hedge funds were waiting, big money were waiting, they were waiting here, they were waiting there. And only after it's gone beyond, at least more than 50% retracement and above, they realized that it's not coming down again. So many people started building their position again. So you can see the volume has gone up here again. Do you see that in May,
Yeah.
end of May? So from end of March to end of May, there hasn't been much of volume. So it's all retail traders that's been trading. Big money only started coming after May, and a little bit more after November, where the vaccine news has come up, right? So it's easy to sell, but not easy to buy.
So quick question, Vinod. You showed the volume data.
Yeah.
So it has got two different colors. What does it mean, the different colors?
Just whether that particular day it finished lower than the open or up above the open.
Oh.
So it's whether it's a green day or a red day.
Okay. Yeah.
Yeah, it's just that.
It's not more selling or more buying.
No. So the volume says volume gives an overview of both selling and buying. It doesn't distinguish whether it's more selling or buying. But if the market has finished lower, and if it had a higher volume on that day, so you could say the upper hand is with the sellers on that day. Does that make sense? So on a red day here, there's red higher volume compared to the previous day, and also the average orange line. So that's I think that's the 20-day average line for volume here. So it's about the average volume the previous 20 days and also the previous day. So that is a significant day, because it how much it lost. So it lost about 3.5% in one day, and the volume is high. It's not just that day, and 3 consecutive days of higher volume. So a lot of selling were going on, although it tried to come up again, and the down days had higher volume than the higher up days. So that signifies there's a lot of rotation and selling going on there.
Okay.
And the green days started having higher volume after the vaccine news. But intermittently, you can see high red volumes. So people are getting a little bit nervous in the market because it's kind of keep going up and up, historically at a very high range. It doesn't necessarily mean that it will come down crashing, but it is a kind of a warning sign, like an amber sign. You would want to watch a bit closer, right? And every stock, every index has its own personality. So that is another useful thing to monitor. For instance, we are on the S&P 500 index, so let's stay here. So after the recovery of the coronavirus crash, it seems to respect the 50-day moving average, the red line, more than any other averages. So it came down when it corrected, it found some support here. It came down, it found some support here. That is because quite a lot of people are monitoring 50-day moving average. Big money, they manage hedge funds and things like that. So because people believe that, it becomes a reality because they feel, oh yeah, 50-day. A lot of people will find that a good place to buy again. So they buy again, and because it's buying, it goes up, and people feel, oh, 50-day is acting as a support, so they buy again, and then it becomes a reality on its own. So it seems to respect 50-day a few times. So here, 1, 2, 3, 4, it broke below, but then quickly it recovered that. Same here. Again, back in January, end of January, again, it came to 50-day and moved up. So 50-day seems to act as a support in S&P 500. Say, for instance, at some point in future, it came down to 50-day and it broke below 50-day convincingly, then you know that it is a change of its character. That means it may not be bouncing back immediately. You may want to sell out of your position or be very cautious and manage with a very short leash. It may do this again, get back up again, and that is fine. You can get back in if you wanted. At least you would have protected your loss, because you never know whether it's going to do this or whether it's going to do that until afterwards. So that's why you need the stop loss and have a bit of a understanding of the character of that particular chart. Having said that, I'm going to show you another, this one. Do you know what this chart is? It says at the back, the background. So this is Bitcoin. So Bitcoin itself is relatively newer product for the financial world, right? So a lot of people don't know how it trades, whether it follows any technicals or not. In the broader framework, if you look at the bigger picture, it seems to follow the technical indicators. Like again, if you look at the bigger picture here, it pulled back, came down to 50-day, tested again, and then it went up. So it seems to respect that 50-day. When it's going up, it seems to respect the 8-day moving average here. Okay. So you'd want to see how the history of that particular product, financial product, the chart has been, in order to get an understanding. Not every chart follows the same pattern. Hope that makes sense. So you'd want to kind of look at it and make that view, decision, judgment call. Arvind, I think you mentioned, some of the others also mentioned in the chat, that they are there for investing. They don't have time for trading and things like that. And investing doesn't necessarily mean funds. Trading doesn't necessarily mean only on stocks and you get in and out quite quickly. You can invest in stocks, or you can invest in Bitcoin if you wanted to have an exposure in it, but not necessarily have to trade every day. Like with this one, for instance, let's say you've been monitoring Bitcoin because it went up from 1,800 to 40,000. This is USD. And then it came down. So people have started to hear about Bitcoin when it went to 40,000, which is twice the amount it was from the last peak in 2017 on 2018 January, right? So people start to hear about it. Because it's gone up, if they didn't buy and they waited for it to pull back, which it did, you could see what has happened. So it kind of found the support at 50-day and had a real strong up day with a increasing volume. So you could probably buy there and then put a stop loss below the 50-day if you want. You don't have to monitor every day, Bitcoin is a little bit volatile. So if you put a stop loss very close to where you bought, you're likely to get out of it. So you could follow the chart like this, and just at the end of the day, when you come back from work, look where it is, and if it is acting a little bit weak, you may want to adjust the stop loss a little bit closer, and so on and so forth. So you kind of protect your capital more closely. But you don't have to trade. You don't have to need. You didn't need the time to trade it within the day. Hope that makes sense. And Bitcoin, I don't know whether you can put stop loss on Bitcoin. Maybe if people are like Umesh or others who are actively using the cryptocurrency could comment on that. I don't actively trade them, so I buy and hold. And if I have some time in the day or end of the day, then I kind of make some adjustments to my positions. The benefit of cryptocurrency trading is it's 24/7, right? So the market is always open for you if you wanted to come and make any changes or additions or adjustments. Stocks, yeah, it only trades during the stock market time. US stock market finishes around 9 p.m. UK time. So that has been quite helpful for me when I come back from work to make that adjustment, either to buy or to adjust the stop loss or to sell it and things like that. Brokerages like HL, Interactive Investor, and some of the other brokerages also offers you the facility to put some stop loss and limit orders. So you don't have to sit in front of the computer to know that trade. So say, for instance, just throw a stock name in the chat.
Google.
You have not gone on a
Google. Okay, CRSP. Okay, I've got two names. Right, let's go with Google, which came. Google. Okay, so just for our discussion purpose, let's say here it touched the 50-day and came up about this black line on high volume. And let's say you come from home, Google is something you've been monitoring, and you notice that 50 days seems to be acting as a support and it's come up now. So let me buy some shares. But I don't have time to monitor Google. And the earnings are coming up as well. So let me put a stop loss. Where would you put a stop loss? You'd want to put a stop loss below the support level. So there's a gap up here. There's a support level here. So you probably put a stop loss somewhere around this level, 1688. And let's say you bought at 1780. So $100, right? It gone up. It gone up to 1920, right? So when you come home, you realize, okay, it's gone up over 1900. I might take some profit, or let me increase the stop loss to where I bought. So increase it to 1780. So you won't lose money unless it gaps down, right? And then you leave it for a few days. You got really busy with work or family, and then you realize, actually, oh gosh, I didn't notice what happened with the earnings season. Thankfully, it was a positive earnings and it gapped up, and it is sitting at 2080. So $300 above where you bought. So your initial stop loss was 1688. You adjusted to 1780 to protect your capital. Now it's gone up again. You can either increase it to below 50 EMA, because that's what the initial support was. So the stock might be respecting that. So you can increase it to 1900, or you feel like, well, actually within the last month, it's gone up a lot. I don't want to be greedy. I'll put a stop loss below this level where it gapped up here. So let me put stop loss just below that level at 2000. So the Google might go sideways for a little bit. It may go up and down a little bit. As long as it doesn't come below 2000, you won't have to sell it. If it goes up again, that's what you want, right? And then you adjust the stop loss. So you don't have to trade individual stocks actively. You can find the stocks, establish a position, and then adjust the stop loss as you go along. Hope that makes sense. And the other stock was CRSP, which is CRISPR Therapeutics. So this is one of the stocks I traded, not invested, I traded. And I took an aggressive entry. So I wanted to keep the stop loss very tight because it was an aggressive entry. I did not get the good buy signal. I wanted to get it a little bit early. So I bought in here because it was trying to move up here. So I want to keep a very tight stop loss. I put the stop loss here below that level. It came down and hit my stop loss. So it was a loss-making trade for me. But thankfully, I put a stop loss there because it's gone down even further here. So that's how the stop loss can work. And I wasn't monitoring it. I was on this trade for about a week. I did not have to see it every day. It hit the stop loss and closed my trade. So I'm glad that I did not lose more. And you can do something similar. So currently, I wouldn't initiate a position, but it's setting up, it's trying to set a base here, in my view. So if it gives a confirmation signal, then I might buy and I might put a stop loss here. So this is for medium-term trading if you want to be really tight with your stop loss. If you say you have a real long-term viewpoint, you're an investor, you believe in this technology, which is gene editing technology, CRISPR, and you believe this is going to be the next big thing, which I think it would be. Genomics is going to be the next big thing in the next few years, 5 to 10 years time. And CRISPR will probably be one of the leaders, is my personal view. And a lot of people share that view. So you might feel like, well, actually, I believe in this technology. And this stock has come down from 220 to 150. So this is trading at a discount now compared to where it was a couple of months ago. I'm going to start investing and gradually add to this position without any stop loss. People do that. Investing and stop loss doesn't necessarily go well together. Again, if your approach is for many years and decades type of investment. One of the great example is like the major winners in the last 20 years, Amazon and Apple and Google, Netflix, and stocks like that. So in the dot-com crash, they all crashed about 90% or 80% and things like that. But if you're bought at the peak of the dot-com, stocks like Amazon and Apple, you'll be sitting on multiple tens of thousands of percentage points, right? So if you put a stop loss, you would have got out of it. Yes, and then you would have been frightened to get back in. So stop loss for long-term investment like that doesn't necessarily make sense. But if you want to be really safer and you are really risk averse in that sense, you may want to kind of use that stop loss as a kind of a comfort, as a containing feature for you. Hope that makes sense. I use II. Krishna Rao asked a question about the charts on II. II doesn't have a great chart at all, Krishna. Yeah, so II doesn't have a great chart. You're muted. I don't know if you want. You can unmute.
No, it's fine. I just wanted to check. How do you look at these when you're actually, you need to go to some other website and then have a look at these, like TradingView or something like that, and then
yeah.
decide.
So I use TradingView quite a lot. They've got free service as well. If you want more indicators to use, multiple watch lists to create and things like that, then they want you to kind of subscribe to their services. But free service is good enough as well. So I use TradingView charts. I mentioned I also have Interactive Brokers account for trading, and they have charts in their brokerage account, that account. So I use charts in that too.
Okay. Yeah, no, I was just checking how to go about this. And the other one is, I just put up a question as well as what's a good approach for some penny stocks which you think, have got good potential. Sometimes, they start up slow and then that, to give a good example, now there are some cannabinoid stuff coming into the UK market. And as a doctor, I know, there are some instances, especially in refractory epilepsy, we are using it quite a lot. So I know this has got some market and it's going to come up in the future.
Yeah.
What's the approach for these kind of penny stocks? What's the good approach for them?
Okay, so the general approach to penny stocks is to stay away from it.
All right.
Cannabis, there was a hype about cannabis stocks in 2018.
No, this is not like cannabis. This is cannabinoid. It's more like medicational. It's not for recreational.
Yeah, so I'm including that as well.
Right. Okay.
So there was a hype in 2018 for both recreational and medicinal use cannabis companies, and it went up, it shot to moon like Bitcoin did the year before. And then in 2019 and 2020, it kind of completely crashed. No, I think, yeah, the 2019 had a little bit of high and then it crashed. It's coming back up again because of the Joe Biden's administration seemed to be more favorable towards that. They haven't made it as a law yet. Some of the states in US have made it as a legal thing to use, and it's anticipated other states will follow suit and will come to UK as well. So those companies that had crashed is coming back up again. And they have at least a few years history of track record, earnings and sales estimates. They are not necessarily penny stocks. They're a little bit cheaper, but they're not necessarily penny stocks. So that those type of companies might be relatively safer to look at rather than what would be traditionally considered as the penny stocks, because
like the ones come into the UK market, they are almost penny stocks really, because there's one come up very recently.
Vinod, I think what he's saying is there's a fresh IPO has come up this week, Canabo, just 2 days back, and it has gone by, it started off less than 10p. Now it is trading around, it went up to 50p. Now it's trading around 30p, just in the last 3-4 days. If you put Canabo, it will come up on TradingView.
I was looking at MXC, not Canabo, because that was medicinal. You know, Canabo is a bit different. MXC is more medicinal oriented.
So let's look at it. Where is it? MXO.
If you put MGC, just put MGC.
MGC.
What comes up for you?
MGC Pharmaceuticals.
Yes, yeah. So this is more with treatment for epilepsy and things like that. It's not recreational or anything like the other Canabo one.
Yeah. So there are different ways to approach this, Krishna. One is if you're following the story or if you're following the chart. Okay. If you're following the story and you are convinced, then you try to get in as early as you want, right? Like IPO and things like that, if you believe that it's going to go up. If you follow this chart, for instance, then generally speaking, any new IPOs tend to, I can't generalize completely, so many new IPOs go up and then it comes back. It creates a base before it goes up again. Okay, so it hasn't created a base yet. You may want, if you are going with the chart, you may want to wait until it creates a base. So I mentioned earlier that I got into US stock investing based on the hype for Facebook investing, right? I don't know whether many people were following the stock market then. Do you know where it opened up on IPO and what's the peak it went to within the next couple of days? Do people know?
No, I have no idea.
Actually, we can get that here. Let's go to weekly chart. It's 20. Shall we go to monthly chart? So this is the monthly chart of Facebook. So it opened up, and I think the IPO price was somewhere like mid-20s or 30 or something like that. I can't remember exactly now, but it went up to 45. Okay, and then with the next 5, 6, 7 months, it came down all the way to 17. The story was there. Facebook had about a billion people following and things like that. So it had the story, it had the fundamentals, but because it's a new IPO, the hype and craze about the IPO sent it high, and then it came down. It set a base for the next nearly a year. So IPO was in June, and it's only after the following August and September it broke out of that base. Can you see that here at 40? So right there. So although there was a good story behind the stock, the chart then pulled back and then it went up. So if you had believed in Facebook, you could have bought at any time at the IPO or subsequently, and then you would have held the stock and it done really well since then. But you could see there's wild moments as well, but that's fine. If you believed in it, you would have still stayed. So it depends on how you want to play that. So MGC. So it's just come up at what 2 cents, 2 pence, and then it went all the way up to 9.3. So the volatility is going to be there. If you're okay with that volatility, as you can see on Friday, it came down by 20%. If you had bought at the top, then you would have been, if you had bought on Thursday end, you would have been minus 20% on Friday. So that volatility is going to be there. I think the trend is there. People are looking at cannabis, cannabinoid, medical and recreational side of things favorably. So it might go up again, but you may need to be able to stomach that volatility. It could go up directly without setting a base. It could come down, but the general kind of stock market history suggests most IPO stocks tend to set up a base at some point. Some shallow base than the others, but it does set up a base. So you may want to kind of analyze how much of a risk you want to take. Say if it sets a base here, you would know where to put a stop loss. But right now, you don't know where to put a stop loss. It can go all the way down to 2 pence. It can come down to 3 pence, or it might set a base here. You don't know. So if you want to have an exposure and you don't mind immediate future fluctuations, then yeah, you can do that. But that wouldn't be based on the chart. It would be based on the story.
Thank you. It's useful to know.
Just to
Yeah,
ask
I think Narayana, did you say there was another stock as well, the cannabinoid stocks?
Yeah, KNB,
so
Kilo November Bravo.
KNB.
Oh, NB, sorry.
Which side you going? Which side? Which side?
Yeah, Canabu.
So it came to the market 4 days ago on the 16th at 10 pence, went up to 51, and now it is at 31. So you can see in the last 2 days, it's come down quite a bit, right? You wouldn't know whether coming Monday it will go up or come down to retest that low. So because you know that it's in the hot sector, you may want to kind of add to your watch list and see how it acts. Say for instance, if it does something like this, so if it does that, does that, does that, and then does this. At least at that point, you will have a bit of a base. Yeah. Then you can buy there and maybe put a stop loss somewhere here. Does that make sense? So so that's how I would approach any new IPOs. And IPOs inherently are going to be a bit volatile, because what is an IPO? IPO is the company is coming public. So there will be early investors, venture capital, the founders, angel investors, and people like that. So they share a little bit of their existing shares to us. Okay, and at some point, many companies have what do they call as lock-in period, where the insiders can't trade. But we need to know all that information when that lock-in period expires. because when that expires, say if after coming to IPO, the stock had moved up quite a lot, and the insiders who have been invested in that company for many years ago, they want to see some returns on that investments, right? So let's say if they're invested at £10 and now it's equivalent to, from their investment point of view, if it has gone up like 10 times, they want to sell those shares to make some money to realize that gains. So when that lock-in period happens, if they sell, that's going to create that volatility. The stock might come down at that point. So us as retail investors, we may not necessarily know all that information. So that's why IPO are very volatile to start with. You wouldn't necessarily know the character of that stock initially. So you'd want to observe that for a few days to see how it sets up. If you're purely going with this chart, at least you would need a base before you get in. If you know the company really well, like there are lots of, a recent IPO was Airbnb, right? Many of us would have used Airbnb. Although the IPO was priced really high because there was a huge demand for it, similar to Facebook, because a lot of people were using Facebook. So if you know that company, if you know the product, you like it, you know everyone likes it, you may want to get in that and don't mind what the volatility is going to be because you have a strong conviction that it's going to go up, then that's okay. But even then, the better option might be, I might suggest, is to wait until it sets a base. If it's completely new IPO, you never know the company, you don't know the business much, you heard it from your friend, what you may want to see is, of course, a base in the chart, and also to see whether their earnings are okay by waiting for at least a couple of quarters to see if they are giving positive, favorable earnings before you get in. So different approaches to take. Let me see. I think there were a few other questions. How diversified we need to be when investing in index funds, i.e. with the... Sundar, are you still here? Do you want to ask that question?
Hello, Vinod. Hi. Thanks for all your advice, really. You know, it is quite useful because I'm quite new to this place and I've never invested in any of this. But for example, in SIP, with the help of a financial advisor, I put some money in the SIP a few years ago, but unfortunately, it didn't grow much really. Over the last 5 years or so, it probably grew by a couple of £1,000. So it's not much. So I was trying to take some of the money out and put it in my own SIP rather than in a private pension.
Yeah.
And being new to this, I really don't want to invest all of it in stocks and shares. I want to invest some in kind of index funds.
Yeah.
So with the current climate, with everything happening, is it good to kind of diversify, when you do even index funds, do you need to diversify rather than based most of it on US related funds? That was the question really. Because initially I was thinking, maybe invest 60-70% in US based index funds and the rest in the others. But now with the change in government in US and the coronavirus, we're still not sure what's going to happen.
Yeah. I'm going to answer it in a couple of different ways because there are a lot of people will be in your situation, so they would benefit from this answer, I think. But I'm going to answer by initially starting to ask you a question. That's the typical psychiatrist way of answering, if you ever want it. I'm going to tell you a few companies' name. I know you asked about index funds, but I'm coming to that in a second. But in terms of US index and US companies, kind of there's some similarities. I'll come to that. So I'm going to tell you certain names of the companies, and I want you to say whether it was US companies or not. Okay. You're in UK, I take it?
Yeah.
Okay. You may not have heard this company. This is just being sarcastic. Amazon.
Yeah, it's okay. It's a US company, I think.
But investing in Amazon, is that investing in US?
No, not really. Yeah.
Yeah. Okay. They're pretty much worldwide.
Yeah.
Apple.
The same again, I think. Yeah.
Okay. Samsung, which is not US.
It's South Korean, yeah.
Yeah. But are you
But
investing in
it's
South
trading
Korea?
in US. No.
It's global.
Yes.
Isn't it?
Yeah.
What else? Throw me something else.
Yeah. Facebook.
Facebook. Yeah. Zoom.
Yeah.
We are doing Zoom. We were on WhatsApp before, which is Facebook company. But you're not investing in US. That's the global growth story. So one could argue investing in Amazon, for instance, or Facebook or Google or Zoom or any of those type of companies is itself is diversified because their growth is based on the global growth.
Yeah.
If say people spending in US lowers, but people spending in Europe increases in Amazon, or India increases in Amazon, Amazon is going to take the profit, and as an investor, you're going to profit from that.
Yeah.
And investing in US index funds, which has most of those companies, is also going to give you that exposure. If that makes sense.
Yeah. I think that's a better way of looking at it. I think that's right. Yeah.
And the same could be said if you are a believer of petrochemical sector, which I personally believe is kind of going to go out of favor and it's already in the declining trend, I think. But people might argue against that. Let's say BP or Shell. They are UK-based company, UK headquartered company, but they have operations in different countries, don't they? And they may be importing those fuels to other countries as well.
Yes.
They are a good dividend payer companies. So investing in certain companies or index that comprises of those companies can itself be diversified in that sense.
Yeah. I think I didn't think in those terms. That's right. Yeah.
So that's one thing to consider in your choice. The other thing to consider is how they have performed recently. You probably have heard from your own financial advisor or the funds you put in, past performance is not indicate your future return. It can certainly guide. The reason why they say that is no one can predict it. But US has done incredibly well in the last 10 years, certainly after coronavirus crash, because they've been pumping the market with trillions of dollars, which is going to stock market. And as a result, they've done really well. UK can come back. UK might be a good recovery play. US may take a little bit of a backseat. It may not necessarily give you the same return that it did last year. I mean, invariably everyone agrees that 2020 is an outlier year. NASDAQ has increased by 47%. The 20-year average for the last, the 100-year average per year is about 10%. So you can't expect that year after year you'll get 40%. It might do maybe 7%, which is good, or 10%. So there may be a little bit of slowing. It might still be really good for long term for us to invest in those indexes. If you're worried about those things slowing down because it has gone up so much, you may then want to also diversify by having other geographical exposure. Maybe a bit of Europe, maybe a bit of Asia. India and China is widely anticipated to be the first and second, or second and first economy in the next couple of decades. So you may want to have an exposure to that. Then you would then look for index that has, or funds that has exposure to them.
Yeah, I think that's quite helpful. Thank you.
You're not restricted to having just one fund in your portfolio. You can have 3 or 4 funds covering all of those things.
Yeah.
So you can do that as well.
Yeah, thanks, Vinod.
Yeah, and I consider I have a little bit of fund in my portfolio, in my family's portfolio, not in my personal ones, in my kids' portfolio and my wife's portfolio, for 2 reasons. One, I'm a bit lazy to keep tracking their portfolio stocks quite actively as much as I do mine, but I also recognize there is a place for funds in any portfolio. I recently published an article in GrowWealth sharing a rough idea of how my portfolio is divided into different asset classes. And that would probably give an idea how I've done it. But I consider my portfolio, which doesn't have any fund, as a fund in itself. I've got about 50 stocks. So I have a Vinod portfolio, Vinod fund, and that has 50 funds, 50 stocks in it.
Yeah.
And I track the performance compared to the index.
Yeah, I mean, you are actually actively managing. You are the manager for that fund, isn't it? So you have to do that.
So this is the investment account, and I don't I don't kind of mess with it on a daily basis.
Right.
I keep a track of it. I kind of adjust, and maybe it's more like a nudge rather than a shift in the account. I have a certain core positions I add and trim it depending on its movements, but it's not as active. I trade actively. I invest semi-actively or passively. So, and that's all in individual stocks, and that in itself is like a fund. As I said, Nifty index in the US, sorry, in India has 50 funds in it, I believe. So, so my account is like a fund because I've diversified in that sense.
Yeah.
Growth funds, but it's a growing company. But I want the companies I invest in to grow. I don't want it to be stagnant. That's not the reason I'm investing. So people sometimes are very apprehensive, and quite wrongly so, I think, because it's called a growth company or growth stock. My question to them would be, why do you invest? You want your investment to grow, don't you? You want the companies that you invest in to grow more than the other company, so you get the return better. And those companies are called growth companies, growth stocks. But that is not all in technology. Many of them are in technology recently, but not all of them in technology. Until recently, I had an investment in a waste management company because we create a lot of waste, and they are one of the leaders in doing that. I had an investment in kind of discount shop, the shop that like Pound Shop kind of thing. It's not a Pound line. It's a US company, but some company like that. So that's based on consumer goods, right? So it's wide range. As long as it's growing fine, then that's okay. So it's a kind of long-winded answer to your question.
No, it's quite useful, really. Because as I was saying earlier, I'm just starting now, so I really don't want to put too many. I mean, all my eggs in one basket, really. I really want to diversify a bit. But as you say, if you invest in certain companies, they're all global companies, so they're already diversified to some extent, isn't it? So
yeah, I'll just put a link on the chat for you to look at. It's one of the posts that I publish in GrowWealth on passive investment, and I also mentioned some of the names of the funds in them.
Okay, I will do that. Yeah, thank you.
Sorry, what is class 1 and class 2 fund? Because I was looking for FTSE tracker fund on HL, and it says class 1 and class 2 fund. But
I don't know what they are.
Yeah.
Do you mind maybe looking further and maybe letting us know in the group? I'm not quite sure.
Okay, I will.
Class 1, class 2.
It says inclusive class 1 or class 2. The same tracker, the fund name is same, but the descriptions are different.
I wonder, I mean, this is a guess. I wonder whether it gives a different rights for the investors. Certainly stocks have certain things like that. Like Google, if you put Google, there's GOOG, GOOGL, because they have different classes of stocks, A, B, and C, depending on whether you have voting rights or not. That's for the stocks.
I think that's right, Vinod. I think I read about it yesterday or day before.
And I wonder whether that is a similar thing for the fund. Yeah, maybe have a look there on and let me know.
Thank you.
I think we're coming close to 1.5 an hour. We'll look at some of the questions and then we'll try to wrap it up. Vijay has asked, how do you decide which moving average to use for a particular chart? I have a standard selections of moving average that I use, and I see if that fits that particular chart. I know a lot of active traders adapt their moving averages to see if it works for that particular stock. I don't necessarily do that because for my trading style, the selected moving averages and the indicators I kind of come up with helps me to make the consistent decision. So I'm sticking to that one. But there are hundreds and thousands of different variations of a particular moving average and different moving averages and indicators to use as well. That comes with experience. I mean, either you go with somebody who you follow and you believe in them and you follow that yourself, or you try different things to see which ones work out for you. Different investors, different traders use different things. Yeah, so that's what I would say for that. Is Krishna has asked normal strategy to put a stop loss below whichever SMA pattern it is following or whichever SMA acts as support. So the ones I showed you are the EMAs, the exponential moving average. The answer is yes and no. So you want the area to look for stop loss is where the support is, and that is primarily the price action. What I mean by price action is the chart in itself rather than the moving average. So let's go back to what was I using? Google, wasn't I, previously? So I was using Google. Let me take off the moving averages. So you just look at the chart. So when you look at the chart, you can see, yes, there seems to be some support here. It gapped up there. There's a previous resistance, and that seems to be acting as a support. And then you overlay the moving average as a secondary indicator. And that is a secondary confirmation. So the first primary confirmation that you look for is the price action. The secondary confirmation is you look for is from the technical analysis, like the indicators.
Yeah,
hope that makes sense.
Yeah, no, thank you. You elaborated that quite well. It's useful for putting stop loss as well, so it's quite good to adjust.
Yeah, well, let me show you. Let me show you another chart.
Because that's my main problem sometimes is because we don't do so much of technical things. You believe in a story, so you sometimes cling on to it for a long time, and it doesn't do. You could have sold and bought 3 times. You would have probably been more profitable.
Yeah. So let's see if I can. So this is the daily chart of a particular stock. So this is quite a volatile stock. Members of GrowWealth has seen this chart recently in one of our presentations. So I was sharing with them how I wanted to have a dip at toe. So I started a small position on this stock here, right here, because it was a very volatile stock. It moved up like 15%. I'm not recommending this approach to you guys. If you're starting brand new, don't do this. And I was taking a little bit of risk here. So I started a position here. It acted really well, so I added to my position, and I added to my position here a couple of times. And then as you can see, 1, 2, 3, 4, in 4 days, it went up 40%. Okay, that is nothing to be shy of. So I took some profits there. Okay, and in addition to taking some profits, I wanted to not lose much of the gain. 50 days, so below the price, so it's here. And even the buy price, initial buy price was here, and it's gone up too much. I don't want to miss out too much. So I thought, okay, this has gone a lot, and previously it's gone too much as well. It has a good chance of going even higher. I wanted to go higher because I'm invested in it. I'm trading in it. But as a protection, I put a stop loss at 100 right here, right at the previous resistance and below this this day, somewhere around that level, below the black line. And then the very next day, a firm came up with a report that was scathing about this company and gave a very short selling report. and then it went down by 63% the very next day. So I had 40% that day. Thankfully, I had the stop loss, so I got out at 100. I bought at 88 or something. So on an average, I had 21% gain on this in 5 days. But if I hadn't put the stop loss, I'd be sitting in a very big overall loss, 50% loss. So that's a real life example of how stop loss can save you, as recent as last few days.
No, that's good to know.
Because you never know which company is going to come up with a short selling report, or which company is going to be sued. US, you might know, that's a big it's a big business, isn't it, to sue companies, to sue everyone.
Lots of lawsuits against all major companies. Recent example, Boston Scientific, after product recall and lawsuit, they've gone down massively. Blue is another big company that's gone down massively.
Yeah. So there's a big business in just suing companies, suing doctors as well in US. So you never know when is that going to come up. So it's useful to have a stop loss like that.
Sorry, just about stop losses, this automatic stop losses on the stock, does that generate the same transaction fee for you like an interactive investor?
Yeah, because it's a trade to get out of the stock, so you will have to pay for that as a trade.
Is the stop loss for stocks a new thing? Because I can't remember when it was like paper trading, or let's say even 5-10 years back, I did some with HL. They didn't ask for a stop loss in those days.
It might be down to the brokerage features. Some brokerage don't have stop loss. So like free trade account for that the account that doesn't have a trade commission, they don't give you the limit orders or stop loss. You can only put market orders. But I think even in free trade, I haven't tested it, but this is what I've heard. Even in free trade, if you have a paid account, you may have that feature available for you.
Okay, thank you.
So stop loss is not a new thing. It might be relatively new for that particular brokerage firm if they haven't had it before, to have it now. I think we would probably wrap it up at that point, unless there is any major burning questions.
Hi, Vinod. I had one question. If you have time, can you hear me?
I can hear you, Raman. Yeah.
It's just the same question which I had put in the chat. Do you yourself use the screening service which TradingView platform has got built in itself?
I haven't used the TradingView one. I have different sources to screen my stock names. There are different services. As I said, TradingView one, FinViz is another company, and there are lots of different places you can find stock screening. Stockcharts.com might also have one, I believe. Some available for free, some you may have to pay. I haven't used the TradingView one. No.
And do you recommend any of these, the ones which you have just mentioned?
So the stock screening is it's just a place where you go and look for things. So the screening depends on what parameters you put in to look for it.
Mm-hmm.
So if you say look for companies that is above $10 with this much of earnings, and that has moved about this percentage above the 50-day moving average, then it will show those stocks. So it depends on what parameters you put in. If they are a reasonable reasonable company, they would have those selections. So you'd want to look at, identify which fundamentals that you want to screen these stocks for, and then go to those sites and see if they give you the options to choose those fundamentals.
Okay.
Because some have a broader range, some have a narrow range. If you're looking for fine-tuning it, you may want to go with a narrow range one to choose that narrow ranged selection process.
would you, this is a question you may not want to answer right now, but would you ever in future, as part of the learning you provide, consider doing a session on stock screening? I know you do provide that service in some way by through kind of your Buy Me a Coffee GrowWealth platform itself, because we get those screened shares. But from learning point of view,
I was thinking
again,
of doing that to the GrowWealth members in terms of selecting. Again, individually, people may have different fundamental criteria they want to choose to screen. I was going to either do a session, the members session, or a post. I was thinking it for members. Yeah.
Okay. Thank you, Vinod.
Thanks, Raman. One last question. I think it was a repeat question which I missed earlier, which is, can I invest in crypto through ISA? So crypto is tradable or investable through different means. So actually holding a crypto, I don't think you can do that in ISA account, but you can invest in crypto-based companies in your ISA. So there's been some mention of certain companies in our Telegram group that does crypto mining and are based on cryptocurrencies. You can buy those stocks in ISA, but cryptocurrency itself is traded through separate crypto exchanges, and there you can't do that through the ISA. There are a lot of leveraged products based on crypto, and that may be possible in ISA if your brokerage allows it. But cryptocurrency in itself, in its truest sense, is not tradable or investable through ISA. So this is promise. This is going to be the last question. So what is crypto mining? So cryptocurrency is a digital currency, right? So somewhere it has to be digitally created. So there are computers, there are companies that create a big warehouse, hundreds and thousands of square feet of space, where they have hundreds and thousands of CPU computer connected with wire, running these programs to create that digital currency. And it is like bringing out that currency, like a mining process would be to bring out the precious metal from the earth. So they are called crypto mining. So the companies that uses that computing power to create those cryptocurrencies, that process of creating that is called crypto mining. Okay, I've got a reminder from my home as well to finish and go for dinner. Hope I answered most of the questions, if not all. Thanks for turning up and your interesting questions. Hope it was useful. Please check out the GrowWealth page as well. I haven't. It spreads by word of mouth and your support and contribution. And if you feel you would benefit more from joining the membership, please do so as well. If not, give me some ideas so I can improve that service in whichever way you see fit. All right, let me stop the recording first.